Record. Yes. All right. Welcome, everybody. I'm Nitsan Mosery. Thank you all for being here. And we have a great guest tonight. And we're going to be talking about underwriting, your do's and don'ts. There's a lot of things going on with underwriting. And this is going to be a little bit different than a lot of other underwriting calls where we're going to talk about concepts. We're going to talk about stories. We're going to talk about how underwriting can affect raising capital and all that. And we have today an incredible woman. Her name is Hitomi Yasuda. She's a master underwriter, and she has. I've gotten to know her in the last several months and this past year, and I know she's been doing some incredible stuff, closing deals, helping people, coaching, and whatnot. So, Hitomi, thank you so much for being here with us today. I appreciate it. Thank you for taking time out of your schedule.
Hi, everyone. Nice to see you all here tonight, and I thank you for your time. I hope you find this super inspiring and helpful.
Yeah, awesome. So, and again, I put in the chat our um, webinar for next week with Blackwell Equities. Go into the chat, click on the link. You can register for it. We're going to be talking about 1031 exchanges, all the good stuff, and how you can work it, and the different aspects of 1031. We all seem to know very broadly what a 1031 is. Doug Blackwell we'll dive deeper into that. So, Hitomi, we're going to talk today about underwriting. What is underwriting in your eyes?
So, underwriting basically, right? The purpose of underwriting at the end of the day is to help you analyze, what it is that you're trying to do, right? As it pertains to real estate investing. At the end of the day, what are we all trying to do, right? What we're ultimately trying to do is we're buying businesses. Okay, we're buying a business, and commercial real estate is considered anything that's over 5 units or more. Okay, but it also could encompass different asset classes, things like mobile home parks, storage units, office buildings, grocery anchored retail strip plazas, right? But all of these things are businesses. So what underwriting helps you to do basically is to really understand this business that you're basically inheriting from the current owner, and then assessing risk, right? Assessing risk as you decide to purchase this particular property, and then how you plan to create a roadmap, a business plan of how you plan to run the asset over the next 1, 2, 3, 7 years, 10 years, however long you plan to hold it. And then also when you exit, when you ultimately decide to sell the property. So underwriting is really all about being able to quickly assess, make some key decisions, and assess the risk of what it is that you're trying to buy when it pertains to your business.
That's great. So let's break that up a little bit because you said a lot in those few sentences. Assessing the risk. What risks are we talking about? Let's start with that.
So as it pertains to a business, right, there's a lot of things that can go sideways, can go wrong. So assessing risk has to do with things like the financial condition of the property, right? What's happening with this property, how it's been currently operated, and then once you understand what's happening with the property, what can you do as the new owner to actually improve operations? And so you kind of want to look at, right, the risk that you're taking on. Is the property, the issues that they're having, too great for you to be able to safely make a profit? Are the issues that's going on with the property, right, the cost that's going on, is that cost something that's manageable for you? The time that it's going to take for you to like implement these different changes, all of these things you're basically taking a look at as to whether or not it's going to be a feasible property for you to buy. So you want to look at your ideas of what you want to do with the property, how much it's going to cost, and the time it's going to take, and evaluate what is your highest probability of success to be able to achieve these things. Then on top of that, from a risk standpoint, right, you want to also take a look at what are all the things that can happen to you potentially that go sideways, right? Unexpected things. And as an underwriter, what sort of cushion have you built in to your business plan, like kind of like an escape route in case things were to go sideways, so that you can continue to kind of get the ship back on track and continue moving forward.
That's
So,
great. Sorry, go ahead.
no, no,
So let me ask you this. We always hear when we're talking to people, when we're underwriting, we always hear this phrase, right? Um, be conservative in your underwriting. Be conservative in your numbers. What in God's name does that mean? Being conservative. How do you know if you're being conservative, if you're being overly conservative, not conservative enough? What are we talking about here?
right. And this is kind of a tricky word, right? Because underwriting is both an art and a science, right?
Mm-hmm.
So the science aspect of it is the pure math, right? There are certain key metrics like net operating income, right? Cap rates, uh, loan to value, things like that. These are all mathematical numbers that it is what it is, right? There's really no getting around that whole thing. So those are what you call just simply the science. The art, however, is how you kind of envision this property, of how you want to run the property. And you as an individual owner, right? You could have two people looking at the same property and you have different visions of how you want to operate it, right? In terms of how much you want to raise rents, or how you want to handle vacancy, or how you want to handle other income opportunities, things like that, right? We all have a different take on what we consider uh, aggressive or conservative. And what we're trying to say with the word conservative is this is where you consult uh, people like lender, insurance, property management people, right? People who are really experts in their area to help guide you with coming up with decisions that give you the highest probability of success, being able to achieve your different strategies. What you don't want to do is come up with a situation where the stars and the moon, everything have to align for you to be able to achieve your different targets and make it really difficult for yourself. So conservative means really pretty much coming up with a plan, but then building in cushion in case things don't go according to plan, both time, money, and resources.
So cushion could be, like you said, time, money, resources. Let's talk about like a rent roll, right? When we're looking at a rent roll and we want to be conservative in how we're going to make our projections with where we're going to take the rent roll. What are some things that we should be looking at in the rent roll to help us be conservative?
Okay. So one of the challenges of underwriting is to not get into the weeds and not get into analysis paralysis, right? Rent roll is one of those, what I call a rat's nest of information. There's like all these numbers and things, and a lot of people get super overwhelmed with what is the information you're trying to pull out of the rent roll to really help make some critical decisions about the performance of the property. So a rent roll and trying to be conservative, really what you're really trying to understand with the rent roll are the differences between physical vacancy and then something what we call the economic vacancy. And what we're trying to determine with the rent roll is how many people are actually living there versus of the people living there, how many are actually paying you? And it's that paying you portion is what's really important. So, for example,
Oops, sorry, I muted you by accident.
okay, okay.
Sorry.
So again, understanding physical vacancy versus economic vacancy, right? So you have a rent roll, say 100 units, you have say 95 units are full, and that's kind of what the broker, right, is really going to push. It's 95% full. But what I'm more concerned about as an underwriter is, okay, of those 95 people that are living there, who are actually paying you though? So if you have 95% occupancy, but the equivalent of say 77% paying, meaning you got a bunch of people that are like 1 or 2 months behind, or only paying half the rent, or some other sort of delinquency or bad debt issues, you have a collections problem. You're going
Mm-hmm.
to have a really hard time paying your mortgage and your overhead and all those kinds of things. Basically, your cash flow is going to be impacted. So that's the kind of thing you kind of want to look at the rent roll, is not just when do leases expire and all this sort of stuff, but of the people actually living there compared to then the seller's financials, who's actually paying you? And then
Right.
from that, you can kind of create a business plan with some cushion in terms of occupancy.
Yeah, I'll share a quick story. We bought a property in San Antonio several years ago, and this was during the COVID times. And um, one of the mistakes that we made was not paying attention to the lease start dates of the tenants. The owner had filled up the units with about, it was a 60 something unit property. And I would say we had about 10 to 15 tenants who had just leased up. They had just put them in. And what we didn't do our homework strongly enough on the applications and who they were. And when we took over, we found out that these people were basically homeless people that he took from shelters and from churches and whatnot. And he'd put them in, and he'd agree, he got in an agreement with, the people who were paying them, who were paying the rent for these people, that they were going to pay rent only for 3 months. So these people were in there, they got new leases, they were paying rent, but in month 3, their income ended. The organizations that said we were going to pay their rent, they said only 3 months. So now we went in thinking we had a full rent roll, but in reality, we had, maybe 10 to 15 units that we had to now, instead of spending time working our business plan, we had to now spend time removing these people or getting other organizations to come and fund them and to start working with them. So that was one thing, just like you're saying, Hitomi, was about the economic occupancy rather than the actual physical occupancy, right? We had to go in and it's important when you're, this is part of your underwriting, seeing the rent roll, seeing who's paying, when did they start, looking at the applications, right? Who's paying their rent and so forth. So that was a big learning curve for us. Thank God we were able to really go in there and make the change and help people and get them paying, and rather than evicting them, we were able to get organizations to come and help them pay for their rents and so forth. Some of them we had to evict because they just weren't paying and whatnot. But it's just to, going back to what you were saying about the rent roll and economic vacancies. That's something that you have to really look at very, very deeply with a magnifying glass when you're looking at a rent roll.
Yep. And then further to that, right, as it pertains to underwriting, one of the mistakes that I see often is this being too aggressive. So let's just say you have a property and you've understand that there is an economic vacancy, right? There's a big collections issue. One of the problems I see with aggressive underwriting is upon takeover within the first year, people are underwriting the vacancy from say 25% vacant, right? Physical and bad debt, and they reduce it down to 5%.
Mm-hmm.
Like miraculously in 1 year, you're going to clean all that up
Right.
and you're going to go from 25 all the way down to 5. That to me is what you call aggressive, right? Aggressive underwriting. Like there is just no way that you can clean it up that fast. So part of being conservative is kind of giving yourself that runway, right? Like you're at 25%, then maybe 20, then maybe 15, like that, at least gradual, bring it down instead of instant overnight success and clean everything up, right?
Right. Right. I see that a lot. I see that a lot in the underwriting. Upon takeover, we're going to reduce expenses. Well, why? How? Just exactly like you said, people just go in and say, well, you know what, they're charging $15,000 a year in marketing. We're going to chop that down to 7,500. Their vendors or the maintenance is $40,000 a year. We're going to cut that down to 25 without any explanation. What I like to tell people is that when you're on takeover, the day of takeover, you're inheriting the expenses and the income of the property. You have to underwrite with those numbers first. So, and then from there you can build. And like you said, it's a gradual changeover, right? I see a lot of times also people saying, oh, rents are now 700 and within the first year, we're going to charge people $1,000. There's no gradualness into that increase. And that's where people get stuck on the underwriting, right? Is they don't take that into consideration, the time factor.
There's a famous expression that says, managing apartments is easy. It's really easy managing apartments. But the key is managing people.
Mm.
Super, super difficult, which is asset management, right? Very difficult. And so, again, one of the problems when it pertains to underwriting and trying to like understand that very first year of takeover. The first year is the most tumultuous year for takeover. You got new systems in place. You're trying to inherit and understand where all the dead bodies are buried and all the problems and things, and just really trying to like start taking over how the property's been run up until this point, right? And then suddenly starting to implement change. And change is hard for a lot of people, especially existing residents, right? They're all nervous, like what's going on and things like that. So like you said, right, one of the things that we like to do is we like to kind of take a look at the expenses of what we're inheriting. And to your point, be very careful, not starting to chop and, slash expenses here, there, and everywhere without fully understanding what's driving those expenses. And one of the really key areas as we talk about people, right? Your staff is the most important resource for you. Leasing managers, maintenance, any assistants, all that kind of stuff, right? And one of the things I see a lot of people do is, let's just say there's a property and the payroll is running very rich, very high, like above normal, for example. I see a lot of people saying, let's say it's at 1,800 or 1,600. Yeah, well, when we take over, we're going to, because rule of thumb is 1,100. Boom, we're just going to chop it down to 1,100. And I say, guys, you can't do that. First of all, you need to fully understand what's driving that extremely high, above average payroll, but you need to understand how many people are on staff, what exactly is everyone doing, right? And once you have that good audit, and if you see that, yes, there is excessiveness or wastage or whatnot, or doubling up, then maybe you can kind of like strategically chop it down. But what you cannot do is take over and then tell that one person that they're making $65,000 a year. Oh, I'm sorry, now you're going to be making 40,000.
Right.
You're just going to
Yes.
have a mass exodus and everybody just quits, right?
Mm-hmm.
You can't just do stuff like that. Because again, people are your most important resource to kind of help keep the machine going.
Oh, absolutely. Your on-site manager, your on-site maintenance crew, your staff, your regional managers, the asset managers. These are the people that are going to keep the ship afloat or sink it.
Mhm.
Right? Your property manager is the person that is talking to your residents, keeping them happy, keeping them satisfied, making sure that the maintenance issues are getting taken care of. And all this is part of underwriting. Underwriting is not just taking numbers and putting it into a spreadsheet and then fidgeting it and making it work so that, oh, we've got a 7 cap or we got a 6 cap and we've got a 7% cash on cash. Great. That's not underwriting. Underwriting is understanding the ebb and flow, the like you said, Hitomi, the people on site, and how important is it to have that right property management team, with you to help underwrite.
It's really, really critical. It amazes me how so many people don't collaborate or form an alliance with a property management company and even an asset management company partnership early on in the process. So you end up underwriting in the dark. And I always say underwriting is a team sport. It really is a team sport. There's a lot of people that you can leverage their knowledge, right? Things to do with lending, the debt, things to do with insurance, okay? And then your operating expenses, right? Local boots in the ground, management companies who understand your type of asset class, the vintage, the number of units, the tenant profile, and the competition, right? They can help you fine tune. They're not going to do the underwriting for you,
Right.
but they can help you fine tune and point out some red flags where you might be being a bit aggressive or you might have overlooked something or some other nuance that's very particular to that market, which is another reason why I'm a big preacher about don't jump around from market to market to market, right? Pick one area and go deep and form
Right.
those relationships with local management companies, your asset manager people, and things like that.
Absolutely. Knowing your market, diving deep into your market, that is definitely part of your underwriting because you need to know what's going on. Are you in the up and coming part of the neighborhood? Are you on the right side of the street? I grew up in New York City and I tell this story, and it's so true. My father had clothing stores, and I think like the first type of dollar store in New York City back in the 70s. He sold everything from chewing gum to cigarettes to Jordache jeans to pots and pans and Fruit of the Loom underwear. He sold everything in that store. But what was amazing was that on the east side of Broadway and Houston Street, on the east side, that's where everybody walked. Across the street, the same street, but just on the other side, I would watch every 6 months stores open and close, open and close, open and close because they thought, well, this is a great block. There's so many people walking down here, but they didn't realize that on that side of the street, that was the place where people didn't walk. On this side of the street, this is where people walked, and who knows the reason why. We're not trying to figure out why. We're trying to understand the pattern of the movement of people. So when you know this market really well and you're investigating it, you can sit and know that I don't want to be on that side of the street. I want to be on this side of the street. And it's that precise that, if you get the wrong side of the street, you could really lose a lot of money. You can close up shop in a couple of weeks. So understanding your market, understanding where people are moving, where the movement is happening, it is very, very crucial. And that helps you to underwrite your projects, right? You mentioned something about rules of thumb. I know, we know and we see a lot of people going in and putting rules of thumb into the underwriting. How does that affect the underwriting? And should we be looking at rules of thumb? Are rules of thumb a good thing? How do you use rules of thumb if you do when you underwrite?
So once again, right, the trick to being a really good underwriter is being fast, being able to make decisions very quickly, right, and being able to assess risk. But you can get good at certain rule of thumbs when it's market specific. So if you've been really good at underwriting certain areas and you do it over and over and over, you do start to see patterns. For example, insurance, right, and cost, things like that, because you're familiar. You know that that's the range that you're seeing over and over and over. But where it gets rule of thumb gets very dangerous is when you apply it blanket, like across the United States,
Right.
right? Certain markets, insurance is still very low, like $400 a door. I've
Mm-hmm.
seen that, $400 or $500 a door, and that's normal for that particular market in the middle of the country where it's not close to an ocean, and they never have tornadoes and stuff like that, right? But you take that same number of door property, 100 units, and it's planted along the coast in Houston, Texas, right? Or like along the Gulf Coast, and near like Florida and stuff like that,
Mm-hmm.
you could be $2,000 a door.
That's right.
This whole rule of thumb thing goes out the window, right? And stuff like that. So it just becomes very dangerous to just kind of use rule of thumb like a blanket stereotype, I guess is the best way to describe it. And that it's just cookie cutter for everything across the board. No, it gets very, very dangerous, right?
And
And
that's why you need to know your market really well.
and so speaking of market, I have this great story of where I'm living proof of this is where I fell into the trap where I right didn't use my own judgment and it wasted time because I'm all about speed, right? So the importance of leveraging a local property management company and knowing your market. So I have a situation, a real life story where a broker knows that I underwrite very fast. So on a Wednesday afternoon, they call me, Hitomi, hey, I've got this deal, man. It's like exactly what you're looking for, like mid 1980s, early 90s, about 130 units, long time seller, like owned it for at least 10 years or so. Okay. And, looking to retire. So I think, you need to get this offer in by Friday. So it's a Wednesday. I got to get the offer in by Friday. And because I've written many, many deals in that market, I was able to quickly use some rule of thumb and I was able to actually pencil, meaning I was able to actually hit the purchase price. Well, one of the first things I do, right, before really submitting an offer is I try to research the area very quickly. So I Google the property, right, to try to see what bad things I can find. And I couldn't find anything. I thought that was kind of odd because usually you find some kind of articles or something. Nothing came up. So I reached out to a local property management company that I have a relationship with and told them about the property. And they were immediately, oh, we know that property. Look it up under this name.
Mm.
And then they hung up. And I'm like, that's weird. It's kind of abrupt. So I Googled this other name, and sure enough, boom, it came up on the web. All these pictures. It was exactly the same property, but it had different color paint, right? All these articles came up. Shootings, 2 shootings in the last 6 months, and there was a stabbing of a little 12-year-old boy, and all these things. And I was like, what the heck is
Ooh.
going on? So I called the management company back. I'm like, what is this? And they were like, yeah, in the last 10 years, this particular property has had a name change like 5 times
Oh,
because
wow.
they've been trying to shake the bad reputation. Okay. And so they said, my staff would be scared working there. Absolutely do not buy this property. You need to run. So I called the broker back and I told them what happened. And the broker was like, yeah, it's going to kind of take someone with thick skin to kind of take this deal down and to run it. But it cash flows. Moral of the story, right? The moral of the story is, as an underwriter, just because something pencils does not mean that you should buy this thing. Okay. So underwriting is more than just, oh, the numbers make sense. The area has to make sense. The actual property itself has to make sense. That all ties into whether or not you're going to be able to successfully execute on your business plan. And we all, right, we all have a fiduciary responsibility to our investors. If you're going to be approaching investors and say, hey, I'd like you to invest in this deal, right? What's the probability that something might go sideways because it's in like a real high crime area and so on and so forth? So that's just something else I wanted to point out, that just because something pencils does not mean you should buy it.
Right. You definitely have to do your research on it because you're taking people's money and they're entrusting you to put it into a property, into a project, into a product that you've done your research on. And I absolutely, you've got to Google the property, you got to make sure, you got to drive it, you got to walk it. You really have to dive deep into it, and this is all part of underwriting. And how does, let me ask you this, so tell me, how does underwriting help you raise capital?
Right. So a lot of people, think that uh, all of these different jobs are separate. Well, I'm the underwriter or broker relations. I'm the asset manager. I'm the capital raiser. And what they don't seem to understand really is that you all ought to be thinking that you're in the same rowboat and you all need to be kind of rowing together in the same direction, as opposed to everyone having these skill sets compartmentalized. Because at the end of the day, underwriting is the bread and butter. It is your roadmap of what is happening with the business. And so even with capital raising, you may not be the one that's going to like plug in all the numbers and the tediousness of into the underwriting tool, but you need to have a firm understanding of what the business is all about, how the deal has been underwritten from a risk perspective, right? So that you can explain this thing to your investors. Because at the end of the day, as a capital raiser, what are we doing, right? We're basically pitching the business plan to our
Mm-hmm.
investors, okay? And what I found from my experience and endeavors in capital raising, and I'm by far still trying to hone my skills to become a stronger capital raiser, because for a long time I was really afraid of public speaking and talking to strangers, right? It was real scary. But the 3 questions that I have encountered over and over the years, the number one question that potential investors ask is, okay, well, I already know, like, and trust you. So that part was okay, right? Because relationships are everything, right? So they already know me. They know that I'm not, shady, that sort of person. So that part, it's okay. But the first question they ask is, okay, well, if I'm going to invest in your deal, whether it's $50,000 or $100,000, whatever, my hard-earned money, how are you going to not lose my money?
Mm-hmm.
How are you going to not lose my money? And what they're asking is, how has this business plan been underwritten so that there's cushion? You have like mitigation for risk, things like that. And you need to be able to explain that clearly to them, right? Not no fluff, no sweeping under the carpet. You're transparent with them. This is, yes, every investment's a risk, but this is how we've underwritten to mitigate that. Then the second question that they're going to ask you is, okay, that sounds good. How much am I going to make then? And once again, you need to be able to explain to them in layman's terms what the returns look like. Because I have a lot of investor friends who are orthodontists, attorneys, massage therapists, right? They've
Mm-hmm.
never invested in real estate before. And to them, terminology like cash on cash, preferred return, AAR, all that stuff over their head, right? When I first got started, even me, I was like, what are all these things? So to be able to explain that to them in a compelling way that they understand it so they feel comfortable is important, right? Because a confused mind says no, and you're going to lose them. And then last but not least, the question that they're going to ask is, well, if this deal is such a home run, right? Are you invested in the deal?
Mm,
So they're checking, well, how much do you believe in the deal, right? So this is where, again, you have a fiduciary responsibility to your investors. When you understand underwriting, and again, you don't have to become a master underwriter, but you at least can sniff out red flags when a deal appears to be written very aggressively, that the business plan seems very challenging to actually achieve that, like everything has to be perfect, right? You can also decide and have criteria that I don't want to raise for this particular deal, right? I see too many people who so desperately want to get into their first or second deal that they think I'm going to capital raise to get into a deal. So then they just like start raising for any deal, anything, without really even fully understanding what you're getting involved in. Do the numbers make sense, right? Have you checked the sponsors on that team, their experience level, and all this sort of stuff? Because again, that's all part of underwriting, right? It's
absolutely.
checking everything so that the deal that you decide that you would like to represent and be a part of is one that you can feel good about, right? So underwriting will help you screen those deals too. So you yourself protect not only yourself, but also your investors.
That's great. Absolutely. Um, what we talked earlier today, you and I, about different stories about how we've learned through our underwriting to look at certain mistakes or certain things that we should have looked at. What are some stories that or some lessons that you've taken away from underwriting deals, and on the actual underwriting spreadsheet it looked one way, but then when you got into the property and you started performing, it was a completely different story?
Right. Definitely. So for us, one of the key things that we've learned, and I've seen this happen to other people too, right? Operators get into trouble because they run out of money,
Mm,
meaning you don't have enough capital expenditure set aside. Okay. One of the big mistakes, problems I see with newer underwriters is that they set aside a CapEx budget and the budget is only for, say, the unit renovation project that they have planned. And that's it. They don't have any other money set aside for the, oh no, right? Things go sideways, emergency things. They literally have the exact to the penny dollars required to just put in new bathroom, kitchens, and flooring, and that's it. Okay. For us, right? I think we were also a little bit aggressive with that on one of our deals where we thought everything was good, right? But what happened last summer, right? Our property, it's located in an area where it gets super, super hot in the summertime. Okay. And it's a little bit older property. Um, and we did what we thought was thorough due diligence about air conditioning systems and having money set aside for, replacement and stuff like that. But we couldn't have predicted last summer that it was going to be over 100 degrees for like 2 weeks in a row. Well, what happened? In a period of 2 weeks, 17 HVAC systems just died beyond repair, like had to be replaced. So now we're faced with a massive customer service issue, right? What's the number one reason why people tend to move out? It's not necessarily because the rent increases,
mm-hmm.
customer service.
Right.
This is their home, right? And so all of a sudden we're scrambling now, right? Scrambling to try to get replacement parts, right? But then the whole community, everyone's having issues. So like vendors are struggling to like supply HVAC machines, right? Then same thing, finding qualified HVAC certified maintenance people running around trying to do all this kind of stuff. So to cut a long story short, $138,000, boom, for 17 HVACs, right? That really took a hit on our capital expenses reserves and stuff like that, right? So that was kind of like a shock to us, like, wow, we kind of underestimated, we should have had a little bit more cushion, right? I mean, we're still okay, but still, it was just, we didn't think it was going to be suddenly like that, a big hit. And then like later on in the year, these are the kinds of like unknown things that can happen. Like who would have thought? But we had a drunk driver. I think it was either Christmas Eve or New Year's Eve, something like that. Drunk driver crashed into the side of the building and then took off. So like a hit and run thing. Okay. The tenant luckily was not injured, right? But a big old hole in the wall. So we had to like 911 call, construction to come and like patch it all up in the middle of the night sort of thing to kind of tie us over until we can fix it, right? So now as a team, the big question from an underwriting perspective, insurance. Of course we have insurance, but what do? Do we claim and then risk next year the renewal going up or perhaps
Right.
even getting dropped by the carrier, or the deductible $25,000, or
Mhm.
do we just kind of eat it and take it out of our reserves and just kind of deal with it? So we had to weigh up all those things. Underwriting, the scenarios, if we did this, if we claimed, what could potentially happen? If we didn't claim, how much reserves do we have and what is that going to do to our budget? So on and so forth. Underwriting. And as a team, right, because everybody on my team is savvy, they understand the numbers. We were able to have a robust conversation, the pros and cons of how to move forward, right? Because you have to make a decision quick. You can't belabor this thing. There's a big hole in the wall.
Right.
So in the end, we decided in this instance, we were going to eat it. And we just basically paid for it from out of our reserves to preserve our insurance.
That's
We didn't claim.
you mentioned something that is key here, that is not necessarily having to do with underwriting, but has to do with decisions and with the team. You got to have a team that can come together in a moment of crisis like that, really put their heads together, understand and weigh all the pros and cons and what to do, and then go out there and make a sound business decision. This has nothing to do with real estate. It has nothing to do with income and expenses. This has to do with a business decision. So when you're building your team, you know, you got to have people around you that can make good sound business decisions, that understand the risks, understand where, how will it affect your cash flow, how it'll affect this. And again, it all trickles down back into the underwriting. I'll talking the same thing. I had a Section 8 property in Charlotte, North Carolina, and we did our due diligence, and we had a nice fat reserve account because we knew it was a Section 8 and there was going to be a lot of wear and tear and so forth. But what we didn't anticipate was that the piping, the plumbing, would just start to disintegrate underneath concrete. And we had a lot of, in a matter of 6 months, a pipe after another pipe after another pipe would just start to disintegrate and to break. And our repair and maintenance costs started to shoot up drastically. And it was eating into our reserves a lot faster than we had anticipated. So, of course, now we have to get the team, just like you said, we have to get the team together. We got to start asking questions. We started looking at the whole big picture. We looked at where is our insurance going to go if we hit the insurance. Where's our real estate taxes? And we're going to talk about real estate taxes in a second. Where are they going next year? And what's going to happen with our reserves account? And at that point, we made a decision that now is the good time to sell. And we were fortunate enough to find a buyer that wanted this type of property, that had already spoken to the city, and they were making plans and doing things with Section 8 and renovating and so forth. That they came in, they bought it from us, and we were able to exit and still make a nice profit and give our investors, their returns that they wanted. But these are things that you have to have, like you said earlier, cushion in your underwriting for the things that you can't foresee. There's this guy on social media, Jocko Wilkins, big Navy SEAL guy or a special forces dude, and he was talking how when you make a plan, you plan for the things that you can control. And he was talking about one of his military maneuvers that they had to do and whatnot, and they didn't plan for weather, because weather you can't control, but yet you can control what happens if there is bad weather. Okay, if there's bad weather, what do we do? We can't control the weather, but how are we going to act if bad weather comes? Well, we'll land. Our landing zone will be closer. We'll do this. We'll do this. We'll be prepared if the bad weather comes in. And it's the same thing for us here, is that we can't predict and foresee everything, but we can plan for the things that we don't foresee and don't expect, right? How are we going to what happens if the pipes break? What happens if we spend more than we need to on CapEx or on repairs and maintenance, and things of that nature?
The kiss of death, right? The kiss of death is relying on cash flow. to pay for these things.
Mm-hmm.
No, you got to have money set aside, and you do not touch your cash flow for those kinds of things. And that becomes a very slippery slope
Right.
to losing your property when you start relying on, right, stealing from Peter to pay Paul for these
Mm-hmm.
kinds of things, for sure. Yeah.
Yeah, absolutely. Last topic we'll talk about, and then we'll open it up for questions. So if you guys have questions, you can type them in. I see one question popped into the chat. If not, you guys can raise your hands and we'll unmute you. How do you, when you're looking at real estate taxes, a lot of times I see underwriting, people send me underwriting models, and their insurance and their real estate taxes are the same. And they haven't, and it goes back to, I think it goes back to what we were talking about is knowing your market, knowing what you're getting into, and how rules of thumb play into it. What do you do when you're underwriting, and we're going to get a little bit into the weeds here, not much, but when you're underwriting real estate taxes, how do you know, or what's your best guess, if that's what you're going to call it, on how to underwrite future taxes?
Right. So taxes is one of those tricky things because it kind of depends on your market as to whether it's a full disclosure state or non-disclosure. And what that means is a full disclosure state, right? The county assessor's office and stuff, they're going to know immediately that the purchase, the sale went through, it closed, and that this is the price you paid and stuff like that. And all of a sudden, it's like an immediate reassessment, and whatever you paid for it now, and however their formula is, and that's the other thing, they all have these wacky, crazy formulas. Boom, you're going to get reassessed, and here's your new tax bill.
Mm-hmm.
Okay. So you have to really, what we recommend is call the county tax assessor's office, find out what is their formula, what triggers a reassessment, what is the cycle, like how often do they do it? Is it immediate? Is it in 2 years, 3 years, all that stuff, right? Because again, it's one of those things, you can't control it. It doesn't matter how good asset manager you are or property manager, it doesn't matter. It's one of those things that just gets reassessed. Um, if it's a non-disclosure state, what that means is they don't know exactly what you've paid for it. So then they have all these different formulas like the NOI method and all this kind of stuff to try to figure out fair market value, the amount that they're going to use to determine the value and then assess your taxes on that. And again, each county, very different. My recommendation is to call the county and get from the horse's mouth how it's calculated, so on and so forth. Okay. But the one trump card that we all have, right, through the help of the asset manager and the property manager is you can always protest. You can always protest your taxes if you feel that it's coming in way too high, things like that, right? And we've actually done that. And yes, you have to pay the attorney or the company that helps protest, but it's worth it because the savings are thousands of dollars, thousands of dollars. But
Yep.
for the sake of underwriting, you absolutely do want to get it as accurate as possible, because if you're short, then you're all messed up now going forward and having it under budgeted, right?
Absolutely. We appealed taxes on one of our properties, and we got rejected. They said no. And that was one of the main reasons why we had to sell as well, because we knew that if we were going to go into next year, the insurance was going to go up, our real estate taxes were going to go up ridiculous amounts of money, and we knew that we were going to be negative cash flowing because of that. So before that assessment came and before we got hit on it, we put that property out into the market. We were we were fortunate enough to sell at the right time. So you got to have the thumb on the pulse of the property and the market to understand what's going on. And again, that comes down to your underwriting. Great stuff. So let's open up to some questions here. Taylor Keith says, if anyone needs help with HVAC and plumbing questions, please feel free to reach out. My wife and I own and operate a plumbing and mechanical company in Central Arkansas. That's awesome, because we're actually looking at I'm very bullish on the Northwest Arkansas market right now. We're underwriting an 82 unit property in Springdale, Arkansas. A great market. Love that area. So I'll definitely keep you in mind, Taylor. You guys go up to Northwest Arkansas? Yeah. Awesome. We have another question from Jasmine. Should you base your reserves after the inspection? What does she say here? Was that done before the piping example? Are you talking about my example with the pipes and whatnot? We did base our reserves after our inspection. We did our inspections. We came in. We knew that this was a Section 8 property. We knew that we were going to get a lot more repairs and maintenance. They were going to treat the property a little bit tougher. We had kids at night throwing rocks at windows, breaking into some of the vacant units that we were waiting to get turned over. But we didn't expect that pipes would just start to disintegrate, right? And that's something that we always have to check. We have here Kevin King says, I always check spot crime on the address and not the property name. Yes, that's a great point, right? Always check spot crime, the address, because just like you said, Kevin and Hitomi, you can change the name several times, and a lot of times that's what people do to change the reputation of a property. They'll go in and they'll change it several times over. Um,
I
oh,
also like to look at Yelp reviews, right, of an existing property, because that's kind of indicative too of the customer service that's going on, customer service stuff, right? So if I read things like, oh my God, the leasing manager is so rude, maintenance man, it's been a week and I can't flush my toilets, I have cockroaches and bed bugs, things like that, not too concerned, because these are things that we can fix,
right.
right? We can fix these things. But if I read stuff like, I'm scared for my life, there's a meth lab and the cops aren't doing anything about it, and oh my God, someone got stabbed, think twice about buying that property.
Right. I was looking once years and years ago. I was looking at a B class property. It was a beautiful asset. However, to get to the asset, you had to drive through gang infested neighborhoods. So while like you said earlier, on pencil, and when you're looking at the actual property itself, it was a beautiful property. It penciled out beautifully. It was fantastic. However, I didn't want to risk or put my property managers, the people that were going to be working for us, at risk having to drive through those neighborhoods to get to work every day. And in those neighborhoods, there was a lot of crime that was happening, right? B&E, breaking and entering, car theft, all that stuff, so as people are driving. So it was something that I said, you know what? The property looks great. The numbers are fantastic, right? There's upside and so forth, but we don't want to take that risk for our people going back and forth. Um, Mike Barone says, what is your underwriting for exit cap rate? Say assets in the market are trading for a 6 cap. Then in year 5 exit, would you underwrite at 8 cap exit to reduce risk, for example? Is there a rule of thumb? And we actually talked about this earlier today, right? How people on the aggressiveness when they're underwriting and whatnot. So what's your take on that, on the exit cap rate?
Yeah. So I think there's two things. You need to be very careful of the going in cap rate as well, right? As well as the exit cap rate. Because the going in cap rate, right? Cap rate is a function of NOI divided by the purchase price. So for example, you could have a particular property, and let's just say you're getting it at an auction. So you're getting it for pennies on the dollar and so on and so forth, right? Or, you're getting a distressed property. So the NOI and all that stuff is not too good, and therefore your price is really low. You could end up with a property with a very, very high cap rate. So the higher the cap rate is considered also higher risk, but also lower price. Okay. But after your ownership and you clean it up and you fix it all and stuff like that, right? Well, let's just say you bought it at an 8 cap. Does that make sense that therefore by the time you sell it, it's going to be an 8 point whatever extra? No, because you would have like cleaned it all up and your cap rate would have normalized back down to like more like what the market is. So you want to be really careful of the going in cap rate, because at the same time too, if you're overpaying for a property because you're being really bullish on it, your cap rate could be very, very low. But then that means your exit also is starting off from a really low cap rate, and you can artificially make your exit too aggressive as well. So kind of going back to this person's question, Mike's question, for us, general rule of thumb is add 10 basis points for every year that you're holding it. So in this instance, if you're confident that you're going in 6 cap is good, right? You feel that is a good starting point, 6 cap, and you're going to exit in 5 years, we would do 6.5. Maybe to be uber conservative, one of the lenders I spoke with about a year ago when things were kind of crazy with interest rates moving around, they were saying maybe you could even do 15 basis points to add to the number of years. And basis points means like 0.1. So 1 basis point is like 10 basis points is 0.1. So 6, add 10 basis points per year. So that's 5 years. So it'll become a 6.5, if that helps. If you did an 8 cap, you would kind of artificially kill your deal. You're being way, way too conservative, and you're probably killing a deal that's otherwise good. But on the flip side, like we were talking about Nitsan, right? You could have some mediocre deals, but you're being very aggressive on the exit cap. And now all of a sudden a mediocre deal on paper could look really like a home run when really it's going to be unachievable, right?
Right. Absolutely. Great point. Thank you. Another question we have from George Edwards. For the larger multifamily, does the property management company absorb community incentives for the residents, or is it absorbed by the owners? For example, like food truck or game night?
That's definitely by the owners. It's part of your marketing budget, right?
Right.
That's why you have a marketing budget. So marketing budgets include anything ranging from a subscription to apartments.com, um, Taco Tuesday night, you know, concessions, right? Like $500 sign-on bonus, move-in bonus, that sort of thing. Like all these different things, whether it's marketing, balloons, flyers, signage, right? All of those things to help with foot traffic, tenant retention, all those things are part of your marketing budget, and definitely the owner is responsible for it.
Right. We used to have at one of our properties, we used to do, and I think it was the one in San Antonio in the summertime, it got really, really hot. So we would have the property manager or the maintenance person outside in the morning with a cooler, just handing people as they leave to go to work, ice cold water on, water bottles. Here you go. You can go to Costco and pick that up for nothing, put it in a cooler of ice and hand it to people as they're going to work. Here you go. Here you go. Stay hydrated. Stay hydrated. It on the dollar cents, it's nothing, right? It's minimal, but on the service side, on what you're doing for your residents, that holds a lot. People will go, wow, this is great. Thank you so much. And that adds to people staying longer in your property and not complaining if you're going to raise rent 25, 30, or $50, those little things. So you should add these things into your budget when you're looking at your marketing expenses. So that's a good question. Any other questions you guys have about underwriting, about how to, where, anything of that nature? We have Hitomi here, so let's get the questions out there. She's a, full information. She's got full knowledge here of helping us how to underwrite and work our numbers. Right. While somebody's coming up with a question, we're looking at a property and we saw that there are late payments. Somebody's been living at the property for 4 or 5 years now, and they've been late with their payments 49 times. What does that tell you when you're looking at something like that? What do you think? Are you going to let that person stay? And there were a lot of people like that on the on the uh on the rent roll, right? So when you're looking at that, that goes back to your economic occupancy, your economic vacancy, your delinquency, right? Chasing after people to pay rent rather than working the model, working the business, and pushing your property forward. So be careful when you're underwriting, when you're looking at stuff like that. As Hitomi said, it's an art and it's a science. The art is the finesse, is understanding, is reading between the lines, reading the rent roll, reading the reading and seeing what it's telling you rather than just looking at numbers.
I just put all my contact stuff in there in my Calendly link. I welcome you guys to book a call. We can chit chat, feel free to reach out.
Yeah.
But underwriting, basically, guys, it doesn't stop when you just submit your LOI, right? One of the things that Nitsan and I were talking about is, underwriting is, don't get so fixated that it's the wedding, right? We're all wanting to find that deal, and you think like, oh, I submitted my LOI and it got accepted, that somehow it ends. It doesn't. That underwriting document is a living, breathing thing. And you are going to look at that over the next 5 years, 7 years, however long you hold the property, because it is your beacon of light. It is the document that's helping you go north, right? The direction that you need to go. And the moment you start going off plan, right, you're going to revert back to that underwriting to try to get back on track. So it's a document that goes beyond just the LOI. It's going to be with you until you actually sell way into the future. So, oh, that is one thing, right? As underwriters, we're assessing risk. You always also want to be looking and thinking about your exit, because it's not just get fixated about the wedding. It's the marriage, which is
Mm-hmm.
the asset management, right? And then not divorce, but eventually you are going to dispose, you are going to sell the asset, right? For the sake of your investors, you want to get that home run. So you always also want to be thinking about your buyer avatar. Who down the road is going to buy your property? And you have to be very mindful of the fact that down the road, that asset that you bought is going to be that much older by the time you're done with it. Even though you're going to make improvements, still, it's going to be that much older, right? And if you've made fundamental changes to it, like unit mixes, like taking a mix of 2 and 3 bedrooms and making them all 3 bedrooms, is anyone going to buy a property such as that, where they're not all 3 bedrooms, so on and so forth, right? Any kind of crazy changes that you might have thinking, like, let's fill in the swimming pool, let's not have a swimming pool anymore, and you fill it all up with concrete and stuff like that. All these kinds of changes, really think about how that's going to impact you down the road, domino effect. And is that going to impact your ability to sell at a home run? Okay, so that is all part of underwriting. Think about the exit.
Awesome. Hitomi, thank you so much for being here. Guys, any last questions? It's been fantastic. Thank you so much. Do we have any last questions before we go? Oh, somebody just popped in. And I just added in there in the chat the link to next week's webinar, Tuesday at 7 p.m. Eastern, where we've got Doug Blackwell from Blackwell Equities. He's going to come in, talk about 1031 exchanges. It's fantastic. And he's got a lot of information. Natalie says, in a team, is the underwriter typically the asset manager since they understand all the details in financials?
Let's put it this way. The asset manager and the underwriter can be the same person, but generally we as a team, at least my teams, we all like to be the asset manager. But in some instances, we will hire a very specific asset manager and then we'll support them. But here's the thing. I know a lot of people think asset management is glamorous and this and that, and it's exciting. But if you want to asset manage, you absolutely have to love the numbers.
Mm-hmm.
So some people think that underwriting and asset manager are separate. They're not. Asset managers are going to be the ones going super into the weeds. They're the ones looking at the profit and loss statement every day, where every dime is being spent, where every penny is being wasted, and so on and so forth. So the asset manager is such a critical, vital teammate if you have a separate one, right? Because that is the person that's going to be basically on top of the property management company, and they're the bean counter, as I like to call it, the
Mm-hmm.
total bean counter of like where things are going and analyzing the reports and so on and so forth. And the rest of the team are supporting them with
That's right.
ideas and facts and questions and all that kind of stuff. So the
Yep.
asset manager, yeah, really has to know the numbers back and forth. Very critical member of the team.
Yes, I would have to say that you might want them to be separate people because you want the asset manager to focus on asset managing and managing the manager, and like Hitomi said, counting the beans. Where your underwriter, they're focusing on underwriting, they're focusing on learning the market trends, the ebb and flow of the market, reading the rent rolls, really going in and underwriting the asset. And if they're asset managing, then they may not have time to underwrite properties that are coming in. And you got to underwrite, you got to kiss a lot of frogs to find Prince Charming or the princess, right? You got to kiss a lot of frogs to find that one property that you're going to say, yes, this is the one that we want. And while your underwriter is doing that, your asset manager is asset managing your portfolio that you have. So
Yeah,
think about it in that sense.
it's almost like the best analogy is the underwriter is like the visionary of long term, right? Where we want to kind of grow this business. And the asset managers are very detailed, the execution on a daily or week to week basis, monthly basis. So underwriters like visionary overall, where we need to be next year, 2 years from now. Asset managers like, oh no, we're going off track on a weekly basis to try to get us back on that track.
Right. Yep. Great point. Great point. Hitomi, thank you so much, guys. Thank you for being here with us. Thank you for taking the time out of your busy schedules to come and to spend time with Hitomi and myself and learning about underwriting. Next week, we're going to be doing 1031 exchanges. And then the week after that, I have my asset manager, Biff, Ramsey, who managed Blackstone's billion-dollar portfolio, Abu Dhabi Investment Authority's portfolio, I believe Merrill Lynch's portfolio as well. So he knows a lot about asset management, regional managing, and he's going to talk to us about numbers, what to look for, how to asset manage, and so forth. Hitomi, thank you so much for being here. I put the link in the chat for next week's 1031 exchange. And if anybody wants to go, you can, I put in my website as well, multifamilyinc.com, multifamily INC. Feel free to reach out to me, to Hitomi. Thank you so much, Hitomi. I appreciate you taking the time and sharing your knowledge and wisdom with us. Folks, happy hunting, and we'll see you on the top. Take care, everyone.